Chapter 2 is where we're going to cover the recording system that is used in order to report the amounts into specific accounts in order to be able to populate or prepare these financial statements that you see here on the screen. Okay, so uh, in chapter 1, we pretty much took the accounting equation here, analyzed the transactions or 8 transactions within this accounting equation, and we were able to prepare the financial statements given the accounting equation here, and which is the income statement, which is also known as the P&L, profit and loss statement, statement of owner's equity, balance sheet, and a statement of cash flow. Okay, but realistically, that's not how these numbers get inserted into these financial statements. It's not just from preparing the accounting equation. Realistically, that's not something that accountants actually do. Um, but so that's not how these numbers get here. So how these amounts get into these respective accounts? Well, I want to illustrate that here first by using the accounting equation. Okay, so before I use the accounting equation, assets equals liabilities plus equity, I want to first go over what recording system is used in order to, adjust a balance in a given account. Okay, that recording tool is called what is called double entry system. Okay, this recording tool demonstrates that there's a dual effect, at least a dual effect that occurs in a given transaction. In other words, there are at least 2 accounts that will be affected for a transaction, at least. So there can be 5 accounts that can be affected in one transaction, or for one transaction, there could be 10 accounts that are affected uh, from that one transaction. But just know that at least 2 accounts will be affected by a given transaction. For example, if you go to the grocery store and you have cash and you spent cash for some groceries, that right there demonstrates the dual effect that that particular transaction had. For example, or to extend on this example, the cash is one account that was affected because you spent cash. Now, what did you spend the cash on? That's the other account that's going to be affected. So you spent the cash on groceries. So whatever you're going to place groceries, or whatever account you're going to use for groceries, is the second account that you're using that shows that dual effect, okay, that occurred. So that's what the double entry system tells you. Okay, so in order to put the double entry system to work, or to increase or decrease a balance in a specific account, you're going to use, or the double entry system uses what is called debits and credits. Okay, so when you debit a particular account, it can either increase or decrease the balance in that account. Same with crediting an account. So if you credit an account, that can also either increase or decrease a balance in that account. But there's some significance to the debits and credits column here. And again, it has evolved into this. Okay, so the debit and credit column reflects the flow of economic resources. So pretty much this tells you that when somebody spends money, it's going to somebody else's hand. And whatever you're getting out of spending that money, that's coming out of that other person's hands. So that's basically reflecting the flow of economic resources, the movement of economic resources. Okay. So on the debit side, no, I'm going to start with the credit side. The credit indicates where the economic resources are coming from. Okay, I know this is a long-winded thing here that I'm doing. Okay, so where the economic resources are coming from, that's what the credit column is for. That's what it represents. In the debit column, Hopefully you can guess it. Where the economic resources are going to. Oops. Oh, I gotta erase that. That looks, yep, there we go. Are going to. Okay, so ultimately the debit column is the destination of economic resources, the destination. Okay, and where it's coming from, that's the credit column. Okay, so this is interesting. That's what the debits and credits indicate. They represent the flow of economic resources. Where the economic resources are coming from, that's from the credits side. Where it's going to, it's on the debit side. All right. So when I go back to the accounting equation, remember from chapter 1, assets are your resources. Okay, this is your resources that you have. Liabilities plus equity, this is your funding sources here. Okay, funding sources. So your liabilities and equity is funding your resources. Okay. Now, when it comes to the debits and credits, this is how it's done. And again, it's best to illustrate it using the accounting equation. So for assets or any accounts that are assets, in order to increase a balance in an asset account, you will debit it. Okay, debit is shown on the left side. Okay, you're going to debit it. To decrease a balance in an asset account, you're going to credit it. Okay. So the minus sign indicates a decrease. So a normal balance that should be shown in an asset account should be a debit balance. Reason why is because when you increase a balance in an asset account, you are debiting it. So normally you should see a positive amount or a debit amount in an asset account normally. Okay. Now we move over to the liabilities plus equity side. Liabilities is going to be opposite of assets. Okay. When you debit a liability account, you are decreasing the balance in that account. When you're crediting a liability account, you are increasing the balance in that account. Okay, completely opposite from assets when it comes to the recording part of this. Okay, equity. Well, equity, we know that it has 4 components. The first component is owner capital or contribution. Owner withdrawals. Revenues and expenses. Okay. So owner capital / contribution. I'm going to try to erase this portion here. There we go. So I can give me more room. Okay. So I'm going to put debit over here. That's the left side. Credit over here. That's the right side. Okay, so to increase a balance in a capital account, owner capital account, I'm going to credit it. To decrease the balance in that account, I'm going to debit it. Owner withdrawals is the opposite. To increase a balance in an owner withdrawals account, I'm going to debit it. To decrease it, I'm going to credit it. Revenues. To increase a balance in a revenue account, I'm going to credit it. To decrease a balance in a revenue account, I'm going to debit it. Expenses is the opposite of revenues. To increase a balance in an expense account, I'm going to debit it. To decrease it, I'm going to credit it. Okay, so these are the 4 components. As you can see here, owner capital normally should be greater than owner withdrawals. This means that it should be a credit balance when you put owner capital and owner withdrawals together. So capital or contribution account should be greater than withdrawals. Now we go down to revenue and expenses. These are our income statement accounts. Revenues, to increase the balance in that account is credit. To decrease it, you will debit it, and expenses are the opposite. So normally and ideally, you want to have your revenues greater than your expenses in order to generate a net income. This means that the credit balance should be greater than the debit balance. So the credit balance in the revenue account should be greater than the debit balance in the expense accounts. Okay. So this is normal, which means that if owner capital and revenue should be greater than owner withdrawals and expenses respectively, then your equity here should have a normal credit balance. So I'm going to bring it down here. So this all of these four components here, owner capital, owner withdrawals, revenue, expenses, it gets lumped into equity here. Okay, which means that equity, if I bring the arrow down, when it comes to the debit and credit column, okay, a normal balance that you should see overall in the equity section within this accounting equation, it should be a credit balance, which means that you should see a higher amount in the credit column than the debit column. Okay, so debit column is going to be a subtraction there. So hopefully that makes sense. This debit and credit here in the equity section is comprised of 4 components of 4 other accounts. That's owner capital, owner withdrawals, revenues, and expenses. Okay. So this video is about 12 minutes long. What I'm going to do is now, or in the next video, it will be pretty much just going over various types of accounts that are classified as assets, liabilities, revenues, and expenses. It's not going to be a comprehensive list because the list can go on and on and on and on depending on how or the complexity of the corporation or a company. So it just will be I'll be listing out accounts that are prevalent. They're pretty much heavily used in the textbook.